to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for tuning in each and every week. You get a prize, and the prize today is information that will help you buy and sell real estate, i.e. what's going on in the mortgage market, what's going on in the real estate market. You know, you can see this show on YouTube. If you go to Jeff Barton, the Mortgage Voice, on YouTube, you can see not only this week's show, but hundreds of shows in the archives there. We also do a live YouTube video about once or twice a week that you can go there and see that, either through LinkedIn or Facebook or Instagram. And all of these things are easily accessible, and getting to us is also very easily accessible. But what we're trying to do is provide you with the best in terms of what goes on in the mortgage business. So that's why we suggest that you sign up. Get like what you see on YouTube so that we can get you the information directly and notify you when we are on the air and when we are sending out more content. Anyway, I'm Jeff Barton. This is The Mortgage Voice, and thanks for tuning in. Okay, there's so many political things going on, it's hard not to just delve into it for 1 second. So there's a great cry of many people on either side, and I call it either side because that's the way I look at it, to be able to do something, fix something, fight somebody in order to get what you want to get. Well, there are many places that you can go to do that. If you want, you can go over to Ukraine. You can go to a number of other southern cities in other countries, South America, Central America, Mexico. You can get all the violence you want. However, if you really want to know what happens when a country doesn't allow you to speak, when a country doesn't allow you to make any particular comments about what's going on in the economy, you see how I drew that back in? The Chinese economy. Now, I talk about China all the time, and one of the reasons I do that is because in a competitive world and the way things look to people who view economics, they say, okay, who's number one, who's number two? This one's coming for that one. Why is one more indispensable than another? There's an article, a great article, by the way, and I'm going to try to figure out exactly who wrote this article. Okay, there's China's dim prospects turn disastrous. This is an article that was in The Hill. Anybody knows to read The Hill and read that publication online? It's great. What they talk about is the same thing that we've talked about in Chinese property sector. Now, 400 million Chinese have come out of poverty into the middle class over the last 25 to 40 years. That is an incredible, and I've talked about it too. Probably the most unheralded great events in human history has been that fact. But in order to do so, they mortgaged the heck out of their future, and it looks like it's about ready to catch up with them. Now, we talked about builders. We talked about developers. We talked about dollar bonds. We talked about defaulting on debt. So I did a little bit of an analysis, thanks to this article, about the debt of the two largest countries in the world. Just to give you an example of the difference between the United States and China. And the reason I bring this up, because yes, we have a lot of dissent, we have a lot of openness, we have people that claim that neither is true, but for the most part, people are allowed to go out there, make a living, and if they don't like it, they can either quit or make a complaint or sue somebody. That's the way it is here. Well, in China, what happened and what has happened is their debt. There's a ratio called the debt versus your GDP. And what amount over your GDP is that debt? In the United States, 98% of this year's GDP is debt. So if the U.S. has let's say it's $17, $18 trillion GDP. And that's about right. Now, $1 trillion is a lot of money. But at 98%, you've almost got that much in debt that the country owes. Now, we all know it's around 22, $24 trillion. Yeah, we know that. So as a result of that, monetary policy, the way we pay off the debt, interest rates, inflation, government spending, which we've seen 6 trillion of it in the last 18 months, really takes on a great meaning. Oh, let's flip to China. You think for us here that's a big number, and we're fighting inflation, we're trying to keep our economy from trashing into a recession while at the same time curbing inflation. China's debt is 275% of their GDP. That's almost 3 times the percentage of the U.S. debt, and their economy is really only a couple of $1 trillion behind the U.S. Now that is something. Now what are they doing about that debt? Well, their answer is to pile more debt on. So taking this 400 million people and putting them in housing, what they've done with their developers is they've allowed them to overextend themselves, to overbuild, to be able to get an apartment, own a condo in China. You have to agree to pay a mortgage before the thing is even built. Matter of fact, before there's even a shovel in the ground, you've got a contract and you're paying on the mortgage. Well, I looked at a video the other day. There's a huge, what do I call it? Anyway, riots in the streets. This is what was called for recently by Senator Graham. For what, I have no idea. But in China, that's real riots in the street. You have a middle class of 400 million people who probably a third of them still haven't got the apartments that they are paying for, who have decided not to pay their mortgages. Matter of fact, they've gone after the developers. They've showed up at office buildings. They've showed up at places all over the country, and they are now in a huge fisticuff melee. Saw a video yesterday about it. Fighting in the streets because the economy, which was based on real estate growth, has begun to crumble. It may take the whole country down. This is why you see saber rattling. This is why you see all of this, I guess, consternation on the part of the Chinese against anybody who could take their mind off what's really happening in China. Now, in the U.S., if we got housing problems, we sure do. 4 million houses we should be building. We're not building. Why? Because the builders don't want to build, because they don't want to make any, they don't want to make a mistake like they did in 2004, 5, and 6, where they overbuilt. And you all remember that the world almost ended in 2008 when there was a real estate crash. Yes, there were bad loans. We're seeing it play out in real time in China. Now, it's not them versus us. We are connected, and we are connected because of the fact that not only dollar bonds are used, the dollar being the default currency, but also many U.S. firms have invested heavily in China. Many U.S. firms still go to their manufacturing core in China to outsource their particular manufacturing and to get raw materials made into something and shipped back to the U.S., which is also one of the reasons why the lockdowns are so heavy in China. Yes, we have problems in the U.S., and yes, there are some issues that we need to deal with when it comes to, economic growth, inflation. Is the Fed doing the right thing by tightening? Now, Mohammed El-Aran, yeah, he says we are. Everybody knows who he is. Jamie Dimon, yeah, he says we are. He said we were behind the curve before we rose interest rates or made interest rates go up. I don't know what the word is. But to be honest, we are not behind the curve now. We might see another 75 basis points in terms of raising the raising the interest rates. Sorry, I was reading something. But when you think about things that could happen and haven't happened, the reason they haven't happened is because the strength of the U.S. economy is so far and above some countries which really borrowed heavily, so heavily that they're about ready to crash their entire economy. And they're blaming it all on a bunch of other things. It's a problem in China. It's not a problem here. So be careful what we all think is wrong about here. Look around the world and see what's going on. Anyway, I'm Jeff Barton. Enough of the preaching, and I'm glad you tuned into the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Each and every week, we bring to you unbelievable guests, great entertainment. And if you want to hear the show, you can go to any number of 5 different stations, 3 different states that we broadcast the show. And every one of these shows, every one of these stations that we broadcast on, they have an archive of not only the current shows, but past year's shows. We're at KCAA and KMET in Southern California. We're at K-Mine and K-Mine Country in Albuquerque, New Mexico, KSHP K-Ship in Las Vegas, Nevada, AM 1400, and up in Lake Tahoe, we are at KTHO, Lake Tahoe, and these great stations have been bringing our information about mortgages, real estate, to you all for, I don't know, 5 years or more, some stations 8 or 9 years. Anyway, thanks very much. I am Jeff Barton, and this is The Mortgage Voice. With me is Ron Mendocino from Mendocino Commercial Realty, and I asked him to come on. First of all, Ron, how are you?
Wonderful, thank you.
Excellent. I asked Ron to come on because real estate is twofold, right? There's residential, which everybody reads about and hears about and is really interested in, but the commercial side rarely gets the play that it should, and because we have a changing market in not only residential, I wanted Ron on to tell us about what's happening in Las Vegas and how the changes with the residential side, if at all, affecting what's going on in commercial.
Absolutely true. Although a commercial broker, of course, I keep track of the residential market as well. And it has leveled off a little bit the last several weeks. It was a crazy situation here. And this is, I think a lot of it was sparked by California buyers. A typical listing on a home had 8 to 10 offers within a week or so of it listing, and many of the sales were cash. Some of my students have told me that up to 40% of the transactions were cash instead of finance.
Wow.
And that was amazing.
Yep.
In particular, California is coming to town. They sold a home for $1.5 million in California, came here, and what was really making the problem is they were willing, because of the demand, they were willing to pay $20,000 to $50,000 over appraisal. And so the typical buyer was shut out of the market.
Right, especially the typical local buyer.
Exactly. The young couple having their second child,
right,
trying to participate in the American dream. So Las Vegas is it's on fire.
Still? Okay.
It is amazing. In particular, we've had esports and so forth. The casino changes here are amazing. Station casinos, who have local stations, primary local customers, they tore down 3 casinos, are scheduled to have 3 of the local casinos that had been shut down since COVID. And they say they're going to sell the land, which is amazing. And so warehousing has just been enormously strong here.
Right.
We have somewhere in the area of a 2% vacancy.
Wow.
So it's just been amazing. And if a person wanting to buy a piece of land in order to build a warehouse or to build apartments, it has been a minimum of $1 million per acre, which has driven up the incredible cost to build anything right now. So that has been remarkable. The town, we have several new hotels are starting to be built already on the south end of the Strip, and a lot of it is venues for entertainment as well.
Right.
So the town is on fire, but the folks building a warehouse or retail, it's taking forever. because permits pulled. In the last quarter, however, they've dropped off about 25% because it's been very difficult to build. For example, permits take months.
Right.
And now Nevada Energy has to be on site when they start the building, and they are 6 to 8 months out once you try to make an appointment. So that has led to incredible pricing on warehousing and retail centers. Now, as you're familiar, as the mortgage rates started going up, that has changed the product available to investors.
Right.
That market has been also very hot. As a matter of fact, as an example, a couple of months ago, a McDonald's restaurant came on the market for an investor to purchase, and it was offered for $3.8 million with a 3.2% return on the money. And it sold in under a week.
Well, that's a terrible return. And it sold that quickly. Oh, my gosh. It
is so surprising. That's why I'm sharing that information with
right.
you. The return was crazy, but all of a sudden, we're unable basically to handle an investor now. We had a couple investors looking for property, and the interest rates rose to be higher than the return. So there was nothing they could buy if they were getting financing.
So they had to come in with cash.
I had a couple clients, they needed financing, and so they were unable to purchase right now.
Huh.
And of course, because of the high interest rates, the sellers were having a heyday, of course.
Of course.
On the other hand now, and they lag behind typically, when interest rates tick upwards, the sellers finally catch on and have to lower their prices a little bit.
Of course.
So I'm finally starting to see some of that happen. So hopefully,
now is that
the interest rates...
Ron, is it crossed over into commercial? I mean, are you seeing any sign that commercial might become more affordable in terms of cap rates that you can get on a return, or is it still going to be this paltry 3%, 3.5%?
Well, the sellers are always slower to recognize what's going on.
Yeah, that's true.
So they're reluctantly starting to reduce the prices a little bit, which of course raises the return. And now it's crept upwards to 3 to 5% in some cases.
Okay. Well, 5%.
Which is approaching closer to the rates.
Now, we've seen Vegas flip a lot over the last 20 years, i.e. it'll be a hot market one day and then the next day, you'll find hard-pressed to find any buyers. Do you see that in the offing, or is there just way too much demand, both commercially and residentially?
There's still a tremendous demand.
Right.
But what has dropped off, Jeff, has been the sales.
Yeah.
Like I have two clients totaling between the two of them about $4 million in sales, and they have to go into waiting till the prices come down some.
Right.
So it has slowed the sales, actually. But interestingly enough, the interest rates have created other issues because about 75% of our transactions, commercial transactions, are leases in Las Vegas.
Of course.
And now what has happened with the interest rates, we have gone 10 or 12 years, Jeff, in which every lease that we did commercially was 3% annual increases in the rent.
Right.
Well, so that's 10 or 15 years. I had no pushback. Tenants expected it, and landlords got it, and everyone was happy. But all of a sudden, with interest rate, with inflation being 7 or 8%, what the heck is a landlord supposed to protect his return with?
New leases. Right.
We on a new lease, we cannot tell somebody you're going to get an annual 7 or 8% increase.
No, nobody will do that. Hey, Ron, we're up against it. I'm sorry, we
Very
ran out
good.
of time. Oh, this is terrible. Okay, so could you tell people how they can get in touch with you, especially if they need a good commercial guy out there in Vegas?
Absolutely.
Thank you.
Ron Mendocino, 702-892-7777.
7777. I'm writing that one down too. Okay, so it's 702-892-7777.
Absolutely. Look
Excellent.
forward to speaking to anybody with any interest, and I'm even happy to answer questions.
Ron, thank you very much. Once again, you come on, you just knock it out of the park. Tell everybody the information of what's going on in Vegas. I appreciate it.
Thank you, Jeff.
Thank you, too. That's Ron Mendocino from Mendocino Commercial Realty. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show each and every week. You know, we're on not only terrestrial radio stations, but we're also on podcasts. And I don't know if we have a list of those podcasts, but I know there's Stitcher and Spreaker and iTunes and iHeartRadio and Google Music Play and all bunch of other ones like podcasts, podclips.io, and of course YouTube. Podclips, I got them all. Man, by the memory. You know, as a quick aside, I'm taking a course, right, at college. I went back to college to see what younger people are like. Hey, you know what? They're actually really nice and really smart and work hard kind of people. Huh. Who knew? Anyway, so it's really improved my brain power. I can't say that I'm quicker or that I remember more, but it allows me to talk more quickly. So that's really good on this particular show. All right, so if you have any of those interests, look us up on those podcasts, sign up, sign in, and you can hear any number of shows, not only this week, but also last week, the week before, going back years and years and years. That's enough for me. I am Jeff Barton. This is The Mortgage Voice, and with us now is Luke Mankey. Luke Mankey is a loan officer, been a loan officer for way more than I ever want to do, but decades maybe. And he works for Malibu Funding, the sponsor of this show. Luke, how are you? How you doing?
I'm good, Jeff. I'm good. Thanks for having me back on.
Thank you very much, and I appreciate it. I know how busy you are. Well, actually, are you busy with the mortgage rates the way they are, and you know the programs really sort of limited, and maybe a little bit more difficult to get a loan today than it was 6 months ago? Tell us what's happening.
Yeah, no, it's all of that. It's definitely it has slowed down, but it's been strangely a busy week and a half here. With just I got a fair amount of buyers kind of deciding they just want to enter back in and go for it and making offers. Nothing's accepted yet, but it's definitely transitioned to a purchase market. There's all I'm doing with anyone that wants to refinance, basically just spending time going through everything and talking them out of touching the loan that they're in. Why would they do that? Because the rates are so much higher now.
That's
so it's
true.
Kind of a blend of just being an advisor, for these people to kind of just educate them and let them know, that it's unless they really need a bunch of equity to go buy something else or do home improvements that are that important, just kind of stick with what you got for now. But the buyers just got to accept what the rates are, and if they want to buy, then it is what it is. At least for now.
Well, the rates. Well, let's talk about rates for a second. I know a lot of loan officers don't focus in on the rate, don't focus in on anything except can you afford this monthly payment? What's your strategy when you're talking to people, especially when they're concerned and they're watching and they hear the Fed and all the things that make people panic when it comes to, oh my gosh, I can't afford that. Do you just get them focused on something simple, or how do you do it?
Yeah, I think, investors are going to do what they want to do, but I think
right.
The majority of the buyers right now are people that want to occupy. And I just think what I'm telling them, and I kind of give them my own personal experience for context, is if you want this place, I don't view these, if you're going to buy something now, don't view it as a short-term play. I don't think you want to buy something thinking you can flip it in a year or two for any kind of substantial profit, if a profit at all.
Right.
But if you want it, and you want to stop paying somebody else's mortgage by renting, then go for it. As soon as rates drop, we can always refinance. But I think it's fine competition softening, so there's maybe not as many people going in and bidding up. That's happening right now, which is helpful. So prices aren't, through the roof at this point, and that helps kind of make it a little more palatable to take a higher interest rate. And so that's what's pushing some of my clients into just buying. They're like, okay, at least I can go get something now. I don't have 30 people submitting, and half of them are cash offers. So I think it's just that. I think if you're going to buy, make sure that you're comfortable and planning on keeping it for a couple of years at least. And then if we get lucky and in a couple of years rates drop a little bit, then we can always refinance. And that's usually what I'm telling them.
You are a very thorough loan officer person in general. You always offer your clients a lot of different ideas on how to get something done. When you're talking to clients nowadays, are you focused more on trying to get the deal done, or are you presenting them options with different payments, different types of structure? How are you approaching the entire process? Now, we say rates have gone up, and yeah, they have, but there's other things in the mortgage business that have also changed. The lending standards have also tightened, and certainly appraisals have gotten a little bit more difficult as well. Tell us how you handle that end of the business.
Yeah, I don't know. I mean, just do our best.
Yeah. Okay. Good answer.
You got to be ethical, and I do self-check myself because I've pre-qualified 30 people in the past couple of months, and I haven't done a loan. So I'm getting to the point where I'm catching myself like, look, you can't talk these people and give them only the positives as to why they should go buy something. Like, you got to be thorough, because that builds, if you give them that level of intel and hand-holding, it's just, I feel like you're building a relationship, and they're going to trust you, whether it's this year or next year or in 10 years. It's unfortunate. It's a lot of work and no pay right now, but hey, we made plenty of money for 3 or 4 years, and it's so busy. So you accept it. If you're going to do this, that's the job, is you got to kind of fully educate them and have them looking at the adjustable rates, looking at 30-year fixed, looking at, there's still plenty of products out there. It's just, just the rate makes sense compared to their, current situation and where they're living, what they're paying. And it's a lot. These are difficult times. This is not a way. This is a whole different thing we're dealing with right now.
Right.
It'll be interesting to see how it plays out.
I agree. Now, let me just jump in there. You talked about loans, the different ways that you can talk to your clients about those loans, and that the mortgage industry, and you let the cat out of the bag, not that everyone didn't know, but that the mortgage industry in general has made a ton of dough in the last 2 years because of COVID and the bailouts and the low interest rates. But how come we read more and more layoffs happening in the mortgage business? Is that just typically cyclical when rates go up?
I think it makes sense when you take a step, at least for me, and I know you understand it well, but for the general consumer or anyone just listening and seeing these numbers of all the layoffs.
Right.
It was just running at a fever pitch for how low the rates were, and so naturally there's all that demand. Well, we need service levels, we need operations to be able to handle all of the volume of submissions. And so there's a bunch of money in it. So, of course, everyone gets brought in and trained and hired. And then now rates go up 3%. Like any other time prior to 6 months ago, you would never tell anyone, like, oh, yeah, rates will go up, maybe sharply, 0.5%, 0.75%. It sucks. Then they hover. We adapt. Maybe they trickle down 1/4, then it trends up, but it's not something where rates go up 3% in 2 or 3 months.
Right, that's
never
true.
Happened, at least in my career.
Nope.
So how does that not just completely put the skids on the market, which it has, and all these lenders and all these companies with a bunch of employees, they got base salaries to pay, these W-2 people. So you have to lay them off. So, yeah, it's going to wreak havoc on our industry with that. I envy them. It's unfortunate being self-employed and contract, but I'm fine with that. Like I made the bet, and I don't have any overhead. So all these companies that have all this overhead, with all these salaries,
right?
There's going to be layoffs.
Okay.
You know all this, but.
We're down to about a minute and a half. Program. Give us your favorite program. Not your favorite program like it's your teddy bear, but I mean, what's the one that seems to be most popular at the moment? The one that seems to be what everybody's interested in.
Oh gosh, I mean, it's what I mean.
Is it 30-year fixed?
I
Is
like
it
all
an
of them.
ARM program? Is it more of a non-QM? What do you, I mean, I know you like them all, but in terms of what clients are asking for, what is it?
It's 30-year. I do wish
Okay.
that there were more. I understand why they're not competitive, but I do wish there were more competitive arms. But investors don't. I don't think they're as interested in taking those risks because the perceived drop in this market and softening of the market. If that happens, then why create another rate? So I understand why there's no arms. It'd be nice if there's a little bit more aggressive, high fours arms if the 30-year fixed are 5.5% to 6%. But
Right.
I mean, my favorite, I don't know. I mean, my favorite is any lender that
Couldn't get you the loan done.
yeah.
That's pretty funny. Hey, Luke, shout out your number. Let people know how they can get in touch with a great loan officer. And by the way, you do loans in a number of different states. I know that.
Yes, we do. Great company, all sorts of options. My number, 818-209-2592.
Excellent. Excellent. Thanks, Luke. Really appreciate you coming onto the show. Always a pleasure. Always have a good time when you do.
Likewise.
Okay, that's Luke Mankey from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for tuning in each and every week. We bring you great information, the information that you're going to need when you make decisions about whether you're going to buy or sell real estate. Normally, in a market that's normal, and I don't know if we've had a normal market over the last 15 years, ever since '08 all the way through now with COVID and the like, we see interest rates going up and down. But before all that, if you want to see me or if you want to get in touch with me, themortgagevoice.com is our website. If you go there, you can see people who have been on the show, the guests, hear a number of different shows, certainly, and you can get in touch with us. That's themortgagevoice.com. I am Jeff Barton, and this is The Mortgage Voice. As I said, we bring great people to the show. And our next guest is first time on the show, Glenn Stern. He's from Kind Lending. I think you're the founder at Kind Lending. Joins us now. Glenn, how are you?
I'm doing great. How you doing, Jeff?
I'm okay. Thank you very much. Now you have a good history in the business. Have built some successful companies, and now are with Kind Lending. How long has Kind Lending been around?
Well, we have been around. About 3 years. Jumped in about 3 years ago, and then before that, I had founded Stearns Lending and had that for about 28 years. And we became the largest wholesale lender in the country. I think second largest lender at one point. So been around for a little while.
No, you have, and one of the reasons I wanted you on the show is because your perspective is long, and you have been through a number of different markets, one like this included. How does this compare to some other downturns in the economy where interest rates have risen?
Well, it feels a little different, and it feels pretty close to '07 and '08, to be honest, but
Right.
It feels different. And what I mean by that is, the rates and the environment was so great for so long
Yep.
that
Yeah, that's true.
I think, that we have, when it changes like it does now, it feels much more painful, right? Because people are going, I want a rate in the twos. I want,
Right.
I want what they had a year ago. And so, it gets kind of, I think you get a little confused on always wanting maybe what you had a year ago. And it's just, we're in a different world again. So.
Well, there is a whole new generation of borrowers since '08, actually 4, 5, and 6, when rates were pretty good, but you could get a loan very easily. They didn't have the standards that they had since Dodd-Frank, and some of the other things gone on to change that particular market to make it more difficult to borrow. I think people who now borrow never really, they weren't in that market. They don't really understand anything but low rates. What's the way that I say would Kind be able to either educate or help people understand that really historically these aren't terrible rates, and as long as you can afford the monthly, you'd probably be okay. What are you doing at Kind to be able to do that?
Well, what I would tell you is these are great rates.
Right.
These are
right.
fantastic rates. If you were to look over the last 50 years and look at the average rate, which is probably more closer to 8%,
right.
Historically. So we're in a wonderful market right now. And like I said, if you just go back a year or so ago, you go, I want that rate. Well, there's lots of ways to get what you want. And what I mean by that is, if you take a lot of borrowers, when we sit down with them and they ask, first thing is, what's your rate?
Right.
And the answer is, well, what are you doing? Is this a purchase? Is this a refinance? Is this, how long have you ever owned a home before? What was the longest you had a loan? Do you have any big, events coming up, like you need to pay for college, or you have something where you might want to get cash out? Every loan is tailored differently for different people. So in a world like today, where maybe if you're going to keep your loan, you usually average 4 or 5 years on the loan, then you refinance or whatever. You could do a fixed rate, but buy it down for the first 2 years, right? And
right.
get something much better, and it stair steps up. You could do an adjustable rate mortgage. Maybe it's fixed for the first 5 years, and then it starts to adjust. There's so many options out there that can get a borrower what they're looking for, and in again a time where you have fantastic interest rates. They just might not be, where they were a year ago when COVID and the world was on fire. So
now with some of the companies like United Wholesale or Rocket Mortgage, they have been at a war with each other, trying to see who can outdo the other to get market share, and whether they're lowering rates, cutting margins, whatever they can do in order to do that. Do you see any danger, like it was in '08, that certain loans would get through that may not necessarily or should not necessarily get through? I'm talking, of course, about any kind of fraud in the market. Is this type of market that you worry more about that than you used to when rates were lower?
No, we're in a different time where now,
right.
I think the lending world has wised up to technology, right? We can go in real quickly and run your W-2s or get a snapshot of your tax returns through what you and I know as a 4506 form
right.
out there. There's lots of ways to verify your bank statements directly from the bank, and a lot of other things that make it a lot harder to do bad loans, right? And
right.
so I think the world has learned, to just be able to qualify you on what you actually do. But what's happened recently, and it's happened, I think, because rates have ticked up a little bit, is it's allowed other investors in the market to come in, not just loans backed by the government, Fannie Mae, Freddie Mac, et cetera, FHA and VA loans. Now you have outside investors coming in, and a lot of them do loans a little differently, and they're catered to maybe the investor or catered
right.
to the self-employed borrower. And again, I'm sure you talked about the non-qualified mortgages out there, the non-QM loans,
yep.
where they aren't backed and they have the same, restrictions as some of these other loans, where they're opening up a lot of doors for people. But they're not like the 2007 and 8 loans or back before then, where they are as
easy to qualify for. I mean, there were signature loans at that
right.
time, right? And appraisals were off, and a lot of what was going on in the loan business was different then than it is now. That's absolutely true.
Yeah, and so I think we've wised up a little bit, and I think a lot of that comes just from competition. And you go back to that war that's on there. Before, I think it was big investors out there, investment houses, that said, well, I'll do a loan down to 680 FICO score, and the next guy said, well, I'll do it to 660, and then the next guy, I'll do it to 580, and
Right.
it just kept lowering the standards to where we finally, were doing some pretty, poor loans out there. And while a lot of people got into properties that they normally wouldn't have got into, they also got themselves into trouble where they weren't as qualified or understood how some of those 0% loans really had interest rates behind them that were ticking up, even though maybe their payment stayed low, their equity was depleting. In the case of today, we don't have such irresponsible loans out there, and that's
I agree.
part of the Dodd-Frank. And so we've got loans that really people are qualifying for, but maybe even in the non-QM space where they qualify a little more common sense. Like, let's look at your bank statement. You show cash, coming in and out of your bank, which shows a banker that you can qualify because you have cash flow that makes it, those kind of loans are a lot different than when it used to be just state your income, right? And
Right.
That's all you need to do.
Hey, listen, quickly, we have about a minute left. What keeps you going? I mean, you were out of the business, and then you decided to get back in. Why?
Well, I mean, yeah, I got out on top, Again,
Right.
We were the number one wholesale lender. And actually, I ended up getting cancer in my throat. And that
Sorry to
took
hear
me
that.
to the core. I wanted to spend some time with my family.
Of course.
I did, sold, and realized once I got through all that, that I really loved the career of home ownership and putting people in the homes
Yep.
and building businesses. And so I'm doing what I love again, and it's been a fantastic ride. We're here to, hopefully help a lot of brokers out there and a
Yep.
lot of borrowers just, achieve home ownership and do things that, you feel real proud about.
You have such a great reputation. I really appreciate you coming on the show. We're up against it, but I really, I'd love to have you back at another time to tell people about what's going on over at Kind. I really appreciate you coming on the show.
All right. Well, I appreciate you too. Thank you, Jeff.
Sure, and thank you. That's Glenn Stearns from Kind Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We bring to you interesting guests, information about mortgages, and certainly the real estate market as well. We can be seen, we can be heard. If you go to YouTube, Jeff Barton, the Mortgage Voice, you can see me there. If you go to LinkedIn or Instagram and you want to follow me, just look my name up, Jeff Barton, and you can. We bring a couple of live shows there each week for about 5 minutes a show. It's called the Mortgage Minute, even though it's 5 minutes. And by the way, somebody stole my name, the Mortgage Minute. There's somebody else in another show doing it. Now, it's a pretty common thing. I guess everybody uses the alliteration of Mortgage Minute, but still, it's my show. Yeah. Come on, get your own show. Anyway, again, I'm Jeff Barton. This is the Mortgage Voice, and thanks for tuning in. All right, let's get right to it. News to use in this news to use section. 30-year fixed rate is at 5.95. Yes, we're almost at 6%. We had down days in the stock market. Everybody has been seeing that. And creeping up of the mortgage interest rates, 5.25 for the 15-year, 5.30 for FHA, 5.05 for the jumbo, 5.95 for the 5-1 arm. That 5-1 arm is still hugely big compared to the rest of the market. I guess that's because the 2-year is at 2.41. 2.41. You think of, I'm sorry, 2.41. 3, I'm reading the thing wrong. It's 3.43. That's what it is. And that is a big number. The 10 years at 3.12. Yes, the dreaded inversion, yes, that's happened, and it continues to happen. Actually, it's widening. As I keep saying, recession in 23, yeah, probably end of second quarter. That's what I'm looking at. Reason is that, we'll see the rosiness of the economy shine through the elections. You know how politicians do it. Anyway, let's see. Okay, right message sent. Rates will will rise until inflation is under control. That is from Mohammed El Iran. He's a major economist. Anybody who knows who he is knows what I'm talking about. Yes, you have to look at what is happening with inflation to understand the Fed, understand the way the U.S. economy is going to go. They're going to make people be unemployed. That's what's happening. Hopefully it doesn't happen too bad in your industry and you all maintain your jobs. What that does when other people lose their job, scares the heck out of you. Start saving money. When you start saving money, what happens? You stop spending money. GDP goes down. GDP is set to go about 1.6%. That's what it is now. If you're looking at the GDP tracker, which we do, we follow it along with a number of other indices and matrices that dictate what has happened in the economy and kind of predict what's going to happen in the economy as well. Sales down, home prices up. That's right. So new home sales and existing family sales or single-family residential units, the sales are down, and we're looking at, 5.1 million home sales nationwide this year, and that's down. But the cost of your home has gone up 10%. Now, that's a kind of a weird number. 2 months ago, the year-to-year, year-over-year rise in your home price was about 20%. So really, that number has been cut in half in 2 months. Yes, it is still going up year-over-year. How long is that going to last? Really depends. Now, we've talked to a number of people, not only in today's show, but on a number of different shows, and I kind of follow it. Real estate's weird because it can really change quickly. If we do enter in a recession, if we do get unemployment numbers that tick up this month, we're going to see some issues when it comes to, what happens to the GDP and what happens to the GDP, and all of that will either say we are in a recession or we're not in a recession. And is that important? Yes, psychologically it is, but obviously if anybody who's lost their job, yeah, that's really important. Let's see, what else is here? Okay, lumber prices, $511. Now, we remember a year ago when they were at $1,733, and that's per 1,000 square foot board feet. So if you're talking $511 from $1,733, you're thinking, oh my, that's really gotten way cheap. Well, not so much. When we started before the pandemic, prices for lumber were, where is the number? $400. So we've really gone up almost 25% from pre-pandemic levels. That makes it more expensive to build anything. We had a couple people on the show recently talking about permitting, talking about how do you get a new house built. I had actually someone, now granted, it's Southern California, granted, it's in Malibu, California where I live. However, they were talking about buying a piece of land and building a property. You might as well just, camp out, dig a big hole, and bury all your money in it, because that's where it's going to go. Most of the money you spend now is in soft costs, not only spending money on soft costs, i.e. geology and archaeology and all the plans and all the engineering of all the stuff you want to do on your house in order to build it, but it takes forever. You could wait 2-3 years before you get permits. I know, I did it. So as the market is what it is, don't build it in my backyard or the NIMBY people come in, yeah, that's going to hurt you. So if you're looking to do something like that, think again. Find something that is cheap or find a different neighborhood. And that really is the advice I have about building. It's just gotten to be impossible to do so. Signs of fraud. Now, we talked a little bit about fraud in the show. And we had some opinion as to, no, it's probably not as going to happen. Loans are pretty good, and I agree with that. I think the front end of the loan in today's market is absolutely excellent. But there are certain signs of fraud in the overall economy to look for. If you see these kind of things happening in the economy, most people who are not most people, but some people will be more willing to cheat than others. One of the things, the major things, changing market conditions. Yes, we've seen that. We've seen rates go from, as we heard earlier in the show, from about 2.5% all the way up to almost 6%. And that's of today, the airing of the show. That's a huge jump, and we did that all in less than 6 months, 6-7 months. So having that be what it is, people want to still get what they want to get, and they might think that they can do what they need to do in order to do that. Don't do it. It's silly. Number 2, tightening of credit. Well, tightening of credit has been around, but even more so now. When we see home builders stop building, when we see new home sales pretty much dry up, the reason is because there's risk involved. one of the things about tightening of credit is that lenders who lend money also see the risk in the real estate market, especially since '08. So they're tightening credit. When that happens, yes, more mortgage fraud can happen. Shrinking market, that's also happening. You're having less people buy, prices still going up, and fewer homes on the market coming new. All those things mean that the product that is still out there, probably in pretty good demand, and those people that want to get that may be induced to do something that they probably shouldn't do. Number 4, rising interest rates. Well, we talked about that already. When things go up, people still want what they want, and therefore they're willing to do more to get what they want than they were previously when it was easier to get. So again, these are 4 signs in the market if you're worried about fraud. A couple other things. HMDA, over the life of the loan, borrow to save $9,400 using a broker. This is from Fannie Mae. If you're a minority broker, you're probably going to save about $10,400 using a broker. Now, there are a number of reasons that you use a broker. They shop around. They have a number of different lenders. You can go to the big box bank at the corner. You can go to any number of large non-depository lenders, and we all know who they are. But if you go to a broker, they can shop all these people, plus a number of other different types of lenders that have niches that they do better than anyone else, whether it's down payment assistance, whether it's VA loans, whether it's FHA loans, whether it's rehab loans. There are all kinds of things that you don't know in the marketplace that a mortgage broker can get you a better deal on. Okay, taxes. Taxes come up. I had a friend who texted me over taxes and how many, I think there were like 25 different taxes that they pay. I added that I hate paying local and city and state taxes. They're the ones that kill you, and also business taxes. But there are some cities out there who have the lowest taxes in the country. Let's get to the top 5. 5, Memphis, Tennessee, on average, median home tax, $1,654. Phoenix, Arizona, $1,611. Louisville, Kentucky, $1,563. New Orleans, $1,345. And the winner, Birmingham, Alabama, taxes on a medium-priced home, $900 a year. That's pretty good. Now, those properties in California, yeah, they're among some of the highest, but it's because the property values are so high. We still have 1.25% tax rate here in California. I'm Jeff Barton. This is The Mortgage Voice. I really appreciate you tuning in, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Now you can listen to KCAA Radio anytime on your smartphone device. Call